Good afternoon and good day, everyone. This is Jason Ulrich with Top Shelf Traders. Thank you very much for joining us. It's 4:15, right on the nose. Well, it just turned to 4:16 Eastern. Market is just closing, and I'm already getting the loud and clear. Thank you very much. Those of you that are just filtering in, welcome. We've got the questions box open, and if you could just give me a quick yes and yes that you can hear me okay and that you can see the screen okay. Barry's got his screen pulled up here. We've got a few folks still filtering in. Outstanding. Yes, yes, yes. All right. We're halfway through the week. We've made it this far. We've only got a couple more days to go. Today is a very exciting day. We've got Barry Burns joining us, and if you've heard his name before, that's not a coincidence. Barry is very popular amongst our readers, amongst the universe of 250,000 plus top shelf traders, and just an all-around fascinating good guy. We're very happy to have him with us. Today he's going to be talking about Fibonacci made simple. And incidentally, I always share a stat from one of our recent surveys because we go out and we ask people, what is it that you're interested in learning about? Mindset, tools, institutional tricks, all of those things. Fibonacci is a constant theme. People are trying to figure out how to use it and whether or not they can make money with it. And so the answer is yes. Barry's going to cover this. And we'll let Barry talk about the specifics of his presentation, but it's going to include things like setting profit targets, the best fib levels to use, highs and lows to use, whether or not the real bodies or candle wicks for drawing Fibonacci levels, that's something you should use, etc. My introduction is not going to do it justice. Barry, of course, is the founder of Top Dog Trading. He's been trading for quite a long time, and the business started with his father, and who had 70 years of trading experience. And is a native of, I hope you're okay with me sharing this, Barry, Detroit, Michigan. So without further ado, Barry, thank you so much for joining us. I'll man the questions box. And also one final detail before we get ourselves out of the gates here. Of course, this is being recorded. We'll follow up with this, and any of the offers or links that Barry happens to share during his presentation, we'll make sure that we include in our follow-up to everyone. So I'll quit the intro at that. Barry, thanks again for joining us, and I'll turn it over to you.
All right. Thank you very much, Jason. I appreciate that kind introduction, and I'm just thrilled to be here. Really excited. I love Top Shelf Traders, and you guys over there, you're doing a great job, an amazing service to the trading community. And so, yeah, it's really a pleasure to be here. And for all of you who are attending, welcome. I'm excited that you have given me the honor of taking time out of your day. I know your time is precious, so I'm going to make sure that we're done on time to respect your schedules, and also provide, hopefully, some really, really excellent and practical information. So I've had the same experience as Jason has, where when I do surveys, people have commonly responded that learning about Fibonacci is at the top of their list, usually within the top 5 at least, of things that they want to learn more about. So I said, heck, okay, sounds good. I'll create a presentation about it. And you are going to get that today, but we're going to, as I said, get into not just Fibonacci, but actually the specifics of how to trade it in the real world. So I'm a real trader. I'm not just an analyst. And so I've got to trade this into the future, because that's where we trade. Hindsight's 20/20, and that's all great, but that's the easy stuff. The hard stuff is, okay, what's going to happen after I get into a trade? And so we're going to talk about that and how to use Fibonacci with some other tools to actually make some money, honey. So let's jump right into it. And oops, got to activate my screen. Here we go. Yay. All right. So Fibonacci fits into the general category that I like to call, and a lot of other people call, market geometry. So it's a subset of the bigger picture of market geometry. Other things that can also be considered part of market geometry would be Gartley patterns, squares, Gantt squares, even astrology, things like that. But today we're just going to focus on Fibonacci numbers, and here are the ratios that we're going to use. So I'm not going to get a lot into the theory of Fibonacci, the mathematics of it. I've got another presentation where I do that. But that one's not geared to be as practical. Today we're talking about the practicality of trading. So these are the ratios, and you're going to see these ratios again. So if you're not too familiar with Fibonacci, you might want to write these down, but they will be repeated on future slides. And these are not the actual Fibonacci numbers. The numbers are in the heading here. Fibonacci is a sequence of numbers, and these are the numbers themselves, 1, 2, 3, 5, 8, 13, 21. And we divide one by the other to get these particular ratios. So 0, 23.6, 38.2, 50, 61.8 is the golden ratio. That's considered the primary one. 76.4 and 100. Now that we've got those ratios established, how do we actually use these? Well, the most common technique, I'm going to share with you, 1, 2, 3, I think I have 4 actual techniques for you today using Fibonacci. And then we're going to combine some of them to make some really cool stuff. So the most common one is Fibonacci retracements. And it's real simple. We look for an impulse move. So in this case, we're looking from this high to that low. An impulse move is a strong directional move. Alrighty. Then we're saying, all right, what percentage will that market retrace back toward the beginning of the move and hold? So Fibonacci levels are support resistance levels. Keep that in mind. They are part of the support resistance family. So if it goes down here and it retraces and goes back toward the beginning of the impulse move, 0, not at all, not even 1 penny, then you have 0% retrace. If it gets up to this line, well, it's retraced 23.6% of the way back to the top, and so forth, 38, 50, 62, 76. Okay, so that's what those numbers mean. Now, I want to show you something because I said we're going to do some realistic stuff here and deal with the real challenges of trading. Not all support resistance levels hold and not all Fibonacci levels hold. So, for example, the next move up, the next swing high is here at 50%. That's a very, very common level. Lots of people trade that level. And that's where the market stops and then puts in a swing high and goes back down. However, notice on its journey there, it sliced right through 23.6. Didn't bounce off of it, didn't even hesitate, didn't even put in a doji, nada, nothing. And so this is the first thing I want to point out, is that we're going to have to answer a question here, and that is, which level is the market going to bounce off of now? And now referring to the time that you're taking a trade in real time on the hard rate edge of the screen. So right away, posing a question will give you the solution here in a few minutes. So slices through that one, slices through and decides to bounce off of this one. So first of all, let's just show you that these levels are significant and they do definitely provide support resistance. So 50 here, then down to 23.6, that's where it puts in a swing low. Swing high now goes up to 61.8. So this time it slices through 50, comes right back down, 23.6 again. So just to show you that, yes, these are significant support resistance levels. So retracements, real quickly, are used as support resistance levels between the high and low of the impulse move. All right, between those two lines. Now let's go to tool number 2. And by the way, we use the word tool there. Fibonacci is not an indicator as such. It is a drawing tool. I happen to have NinjaTrader on right now, and you access your drawing tools here with this little pencil and the little arrow there, and that's where you'll find your drawing tools. If you're using a different charting platform, of course, then well, you'll have to contact the support team of your charting platform to find out where you access your drawing tools and which Fibonacci tools they have available to you. Okay, so you draw them by placing your cursor on one swing high and then down to a swing low. So that would be our first impulse move. But this time we're going to draw Fibonacci extensions, not retracements. So the extension tool is a 3-point drawing tool. So you click here, you click there, and it's still going to stay active, and then you click there. Now, what this tool does is it's not measuring retracements between that high and that low. It's actually drawing extensions from this high forward. And what's cool about this is, well, that's what we've got to trade. It's the future. We've got to trade the future. So now we are looking for price targets. Quite often, Fibonacci retracements are used for entries, to enter back in the direction of that initial trend or impulse move, if you will. Extensions are often used for price targets, exits. So entries, exits. And again, you can use them for many more things than that, but that's one of the most common usages. So extensions are about the future. Now here's another cool thing about extensions. Let's say that, well, let me point this out. So first of all, there is our first impulse move, and you'll see it draws levels below that low. So now if we're looking for profit targets, all right, we have the same ratios, but now we're going beyond, this is why they're called extensions, we're going beyond the low, not back up in here, but down here. Now, one of the practical applications of this can be when you're trading a market that is making all-time highs. So you now are going to be asking, well, dang, where am I going to get out? Where do I look for profit targets? Maybe it's gone beyond its 52-week highs, maybe it's lifetime highs. So now you get no resistance levels above you, no price targets in order to look for resistance, right? Well, pull up your Fibonacci extension tool. That's where this can come in. Even if there's been no previous historical highs, you can use this to establish new profit targets for highs. Now in this case, we're going down, and as you can see, we go down. Where do we go? First swing low is at 76.4. Swings back up to 38.2. Then it goes all the way down to 100. Now 100 is very significant. So this, from 0 to 100, is the same range, price range, as this high to that low. That's what that means. And there's actually a term for that. It's called a measured move. Very well known in trading, therefore has kind of a, well, self-fulfilling prophecy, I guess you would say, because so many people are looking at that. It actually has a term, measured move. So I would encourage you to always have that on your charts for profit targets, because yeah, it's uncanny how often the market will go to that level. Now, eventually, markets, it'd be nice if they just went straight to our profit targets, wouldn't it? We wouldn't have to sit through all the wiggles. But no, the market's not usually that accommodating, so it goes down to 76, and then it wiggles back up to 38, kind of moseys and meanders, and then finally it gets down there. Okay. Now, even if the market's not going to continue down further than this, these levels still function as support resistance for swing highs and lows. So now it gets up to 23, goes back down to 76, and goes back up. Okie doke, cool, cool. Now let's combine those two into what's called Fibonacci clusters. So this is our impulse move from this low to that high. And our retracements are listed here on these labels. Then, again, notice, even though that's our impulse move, it didn't go straight up there. Note, the market wiggled up there, went up here, and then came down here, and then eventually got up there. Well, that provides us the opportunity to use our Fibonacci extension tool. So low, high, low, 3-point drawing tool. And now the labels over here, those are our Fibonacci extension tools. So they're measuring above this high. There's your measured move there. It actually gets beyond the measured move this time. And by the way, oh, I should mention this too. So you can put in levels above 100. So your next level would be 123.6, which actually does come in right there. So yes, you don't have to stop at 100. In fact, you shouldn't stop at 100. And different trading platforms will allow you to put in a different number of levels, and so that's software specific. But yes, they will, if you have Fibonacci extensions, they will allow you to put numbers in above 100, and you should. Okay, so now when it comes to clusters, what we're looking for is where these levels come into proximity. So what I see people doing is they say, oh, look, we got 76.4 here and we've got 38.2 there. Therefore, we got two lines, and so the two lines make it stronger support. Well, yes and no. It's the idea is kind of correct, but here's the reason for it. It's not that there's two lines. These lines don't really do anything, okay? I think sometimes as screen traders, we can start to think that the wiggles, the jiggles, the lines, all that kind of stuff actually make the market move. They don't. Technical analysis, including this, is the map of mass psychology. You might want to write that down. It's important to keep the reality of what's really going on here, be realistic, and understand the logic of the market in your trading and not just technique. So again, I'll say that. Technical analysis is the mathematics of mass psychology. So, for example, I was trained at the Chicago Mercantile Exchange, so I've been down on the floor and all that kind of stuff. I got to see it firsthand. So the market is people buying, selling. It's really an auction place. I like that. Market profile proposes that as a good way of looking at the markets, and I like that. I like that model. So you've got people who are buying, selling. It's supply, it's demand. Think of it like if you go to an auction, right? Like an estate auction, and they bring up a painting, and people start bidding on it. Well, what's that going to go for? What price is that going to get? It's basically going to be worth whatever someone's willing to pay for it. So you're going to have some things that are just not very popular, and then others that are very popular. The ones that are very popular, people will keep bidding the price up and up and up and up, and it'll sell for a high price. Supply, demand. Part of what makes something valuable too is if something is one of a kind, this is the only one that exists in the world. Well, the supply is almost nothing. It's one. And you've got thousands of people who want it. Well, that's going to raise the price. So markets work in that same kind of way. So when we look at clusters, bringing this back to Fibonacci, the reason that clusters actually are significant is not because there's two lines there, but rather because you have two groups of people. You have a lot of people who are looking at the retracement. So some people are just using the Fibonacci retracements. So they're going to see the 38.2 level. Other people are using the, right here, 1, 2, 3, the extensions. And so they're going to see the 76.4 level. In other words, you've got more people now, one group with the retracements, one group with the extensions, and this goes for any other type of support resistance levels. Maybe you've got some people looking at, if it's an intraday chart, floor trader pivots, or major swing highs and lows from history, or anything else. Wherever you get these clusters of any type of support resistance, you're getting another group of market participants who are seeing that. And they're then prone to respond to it with buying off that level, selling off that level, or taking profits into that level. And the more people you get doing that, the more significant that level is, obviously, because that creates more buying and selling and taking profits. So we could see this in Chicago. When you're down on the floor there, I mean, yeah, we did have computers and so forth, but the one of the indicators actually on the exchange is the volume. Now, you might think I'm talking about the volume of the orders, of the contracts. And yes, that is part of it, although that's not an indicator. That's just a statistic. But I'm talking about the actual audible volume on the floor. So you could just stand there and you could tell, oh my gosh, okay, everybody's going crazy, everybody's going nuts, it's getting really loud in here, so the market's going to move. And it is. It's moving, it's hauling, well, but it'll be nice. Other times the market's real quiet, the room is quiet, and people are leaning against a table reading a magazine. There's another guy on the other side of the room flirting with a girl, And you know, if you looked at a chart during that time, you're going to see this kind of stuff. This kind of stuff. Okay, so again, important to understand that these represent, this is just a map of what's going on in the real market. So, yep, this holds because a lot of people are seeing it and buying off of it or taking profits. This is another important thing. Just because you got support resistance doesn't mean the market's going to bounce off of it. Support resistance lines sometimes are where the market finds a fair value, a balanced market. And that's what's happening here. Again, we get a cluster. There's your measured move. There's your 23.6. And people are now indecisive. There's no strong sentiment one way or the other. Everybody's like, wow, we had this big move. Now what do we do? I'm not sure. Uncertainty. No dominant sentiment. But what's it do? It finds its fair value at support resistance. Alrighty. Now, let's get into some of the more unusual techniques for Fibonacci. So those two are very common. Those two measure price levels. And I think we are very familiar with talking about price levels as a support resistance. And that's great. You should be. So, but let's go beyond that. Now, W.D. Gann, who I think had a lot of fantastic stuff and a lot of kind of esoteric, bizarre stuff as well, which I don't get into. But, you know, if you read some of his older works, which I have, it reads just like good old classic, solid technical analysis. It's really amazing. It's like, he's not that weird. And then later, yeah, he got a little got kind of interesting with some of the stuff he put out there, which nobody could understand. Anyway, W.D. Gann said something very interesting that I do agree with. And he said that trading is about the confluence of time and price. Now, that makes a lot of sense because if you think about it, a chart is a two-dimensional object. So we've got price on the y-axis over here. And that's what everybody uses for support resistance. Good, you should. But the problem is you cannot ignore time. And time is on the x-axis. So a chart is only, that's what you got, two dimensions, time and price. A chart is a two-dimensional object. And yet, I find very few traders actually give much emphasis to learning how to time their entries. Most traders don't have any kind of timing tool, even on their charts. It's all about price. Price levels, price action, candlesticks, indicators based on price. And again, that's all good. But you got to have something to measure time as well. Otherwise, you're missing out on 50% of the information on your two-dimensional chart. Now, if trading is about having an edge, which it is, how can you establish an edge in trading if you're ignoring 50% of the information? You can't. In fact, W.D. Gann actually said, of the two, time is more important than price. Well, I'm not sure I agree with that, but I think they're both equally important. So let's talk about time. Now you can use Fibonacci for time support resistance. What? Time support resistance? Barry, what are you talking about? I'll tell you what I'm talking about. Notice how the other lines were horizontal, right? Because they were measuring price support resistance. Now these lines are vertical because they're measuring time support resistance. So this is called the Fibonacci time extension tool. We draw it in a similar way as we did before. We take a low to a high, an impulse move. So this little line here indicates that I started here and I ended there. Okay, and then because it's an extension tool, it draws the lines into the future where we've got a trade. So you gotta have something that gives you future indications because that's what we're trading, the unknown future. Alrighty, so notice we're using the same ratios, but now we're adding them to 100. So we're going beyond 100 because what? They're extensions, right? So 123, 138, 150, 161.8. So now the market just goes sideways for a while. And then when do we get our next move up out of this consolidation? At this time. 123.6. Bam! Cool. All right, comes back down. When does it make our next swing low? Right at 138.2. That's the time the market moves back up. When does it find its high? At 150. Yep. When does it find its next high? At 161.8. So the stuff works. It's amazing. And this can really help your trading. Now, again, talking realistically, because I'm not, I mean, theory is great, but you got to test the theory to see if it's actually going to be of any practical importance. And you have to understand its limitations. Everything has limitations. There's nothing that's perfect. So one of the biggest important things psychologically in trading is to overcome the illusion that you're going to catch every major high and low or every major move in the market. Not going to happen. Nobody does that. It's impossible. So, and we don't have to. That's the good news. You don't have to. We're just here to make money, not to be right. So, limitations. We had a nice swing high here. The Fibonacci time extensions didn't come in there. So what? So what? Right? Doesn't catch every high and low. There's another little swing low. Was there a time extension there? Nope. Okay, so what? We just don't trade it. We just trade when it does appear, because we don't care if the market makes some swing highs and lows when it doesn't intersect with the time extension. Great, let somebody else make that money, right? Someone else has to make some money. We can't have it all. Let some other people have money too. Don't be greedy. So we'll take our piece, let other people have their piece, and then we're all golden. All right, now, you think that's cool? Let's make it even cooler. So we've talked about time, we've talked about price. What if we could combine both into just one tool? So you could do these Fibonacci extensions and retracements, and then you could also put on there your Fibonacci time extensions, and you're going to get a grid of horizontal and vertical lines, right? And that is one of the things that I do. But then the charts get to be, well, it can be a little messy. You've got to be careful of the scaling and so forth, because you don't want the lines to all be too close together, otherwise they become meaningless. So here's a tool that really simplifies using time and price together. So this is called Fibonacci circles or arcs, and they measure both time and price in one drawing tool. So again, same technique. We start from a high, we go to a low. We measure a strong impulse move in one direction or the other. By the way, again, we do these off of fairly strong impulse moves, not off of small little moves. So that's how you draw it. It's just a 2-point drawing tool. Click, click. And it will draw these arcs. Notice how it's not horizontal, it's not vertical, it's kind of curved, right? Some trading platforms will call it circles, some will call it arcs. Both are right. Technically, they are circles. If I were to scale this chart out and look at it from the sky, from outer space, then you would see that it actually does form a 360-degree circle. So it is a circle, but a lot of trading platforms call it an arc because usually what's visible on the chart at any time is just an arc. So yeah, just let you know that if you have a different term on your charting platform, it's the same thing. Don't worry about that. So the reason it measures both time and price is because the slope, it slopes and it changes. So for here, it's this time and that price. But now over here at this price level, it's at a different time. See that? So it changes both time and price constantly. And then if finally the market says, okay, time, price, bam, down we go. So confluence of time and price. Does it catch this low? Nope, that's okay. Marker goes back up, goes to the next. Now again, these are plotted into the future. So we're going to see this line here, this arc, even before we get there, even before price action gets there. So as we approach it, we start to get ready. And we say, oh, I've got a kind of a leading indication here of time and price resistance. So yes, time has resistance levels as well. And this has both together. So very cool tool. Play around with it. Let me give you one, again, very practical tip. This one is a little tricky. A lot of people don't know this. So I'm going to give you a little secret here. Because if you don't know this, it will totally mess you up. This tool, because it's measuring time and price at the same time, you have to have a, well, again, different terms for different charting platforms, but you have to have a static chart. You have to set the scale, a fixed scale. That's usually what they call it. Yeah, you've got to have a fixed scale on your chart, not a dynamic scale. So in other words, if you have a dynamic scale, what it will do is, especially, well, anywhere on the chart that price goes to the top or the bottom, it doesn't want the price action to become invisible off the top or the bottom of the chart. So what it does is it rescales the chart, and it might make these numbers closer together or further apart in order to keep everything on the chart. You can't do that with this tool. You don't want that, because what will happen is when the scale changes, these arcs will actually move. Yeah, and it'll move off that high, and it becomes useless then. So you set your scale. A NinjaTrader, I can tell you, you can just literally left click on this axis here and just slide it down a little bit, even just a tick or two, and release it, and it will set the scale. But you can talk to whatever charting platform you use to ask them, how do I fix the scale? Then once you do that, these arcs will stay in the same place. But you've got to do that, otherwise the tool, you'll look at it and say, oh, this doesn't work. Yeah, it does work, but it's changing on you, so that's why it looks like it doesn't work. Okay, so let's see. I think that's enough of that one. Okay, so now let's talk about the practicality of how to make money with this, because again, Fibonacci is support resistance, fits into the category of support resistance, whether time or price. And you cannot trade support resistance alone, which is why I showed you on the very first chart how we retraced and we went right through the 23.6 without even acknowledging, went right through the 38% without acknowledging that retracement, went up to 50%. So then that begs the question, okie dokie, so how do I determine which of these levels has a high probability of the market holding and bouncing off of them, and which ones will the market slice through? Because obviously if the market didn't slice through support resistance, it would never go anywhere, and well, we wouldn't really have a market. So we've got to use other things along with it. Support resistance is one piece of evidence on your chart. One piece of evidence. And the number one does not give you a probability scenario. We need more than one variable to establish a probability scenario. So I use 5 non-correlated variables, and here they are. Let me give you the list. And these are all what I call energies. Energies. What I'm really doing is I am trading the energy of money. And what I mean by that is, probably the best term would be money flow. So back to my example in Chicago, we'd see people rushing into the pit, and you see orders going through real fast, right? And so a lot of energy in the room, you feel the energy viscerally. Well, we want that energy mapped on our charts now. And I break that down into 5 subsets. Number 1, trend. And I always look at them in this order, by the way. So my trading is very objective and very orderly. So the first thing I look at is trend, direction of the market. So I use a moving average for this, 50-period simple moving average. Are we up or are we down, or is there no trend? Makes sense. Good place to start. Which side of the market do I want to be on? Or is there really no direction, in which case I'll probably either take a neutral options position or just keep my powder dry, or wait for a trend, or even trade a different market that is trending. Here's the other secret. Trading trend is not enough. You want to be early in a new trend. You've probably heard the phrase, the trend is your friend, right? And then you've probably heard the rest of it. The trend is your friend until the end. And all that's true. But I find that a lot of people miss out on what that little slogan is actually instructing you to do. It's not just saying trade with the trend. That's how most people interpret it. And that is a half-truth. So you're not wrong. It's just not the truth, the whole truth, and nothing but the truth. Okay? The truth, the whole truth, and nothing but the truth about that slogan, the trend is your friend until the end, is the operative term at the end. And it's not saying trade trend reversals, because those are very hard to predict. It's saying trade early in a new trend. That is the lesson of that slogan. It's much easier, it's a much higher probability trade to find a trend and trade early in a new trend. And so that is the mean. Don't trade the end. It's not your friend. It becomes your enemy, actually. Trend is a fair weather friend. Okay, so, but we still want trend at early in a new trend. Number two, then, I look at the energy of momentum. So some of you may have had this experience where you say, you know, I trade the trend, but it seems like whenever I trade the trend, I can watch that thing go and go and go and go, and it'll keep going until I get in. And it seems like whenever I get in, well, that's the end of the trend. That's exactly when they stop trending the stupid market. In fact, I've had people say, you know, I could be a counter trend indicator. I should put together a little service where I blast out whenever I get into a trade. And I just blast that out to, 1,000 people, and they pay me $50 a month or something. And then they'll know, oh, okay, Tim got in, so time to go short. They should trade against me, because it's so uncanny how often they say they're wrong. In fact, some people say they're often so wrong, they start to get a little paranoid about it. I had a doctor, actually, who works at Cedars-Sinai, and he said, I'm convinced there's no way I can be wrong this often. I am such an imperfect trader. I'm perfectly imperfect, were his words, actually. And he said, he came up with all these conspiracy theories. He said, and he actually called his broker, and he was accusing his broker of trading against his personal account. Other people say, oh, the market makers, they know where my stops are, it's made public, and so therefore they're running my stops. Well, I'm not saying those things don't ever happen, but that's not really the problem. The real problem, if you're getting stopped out a lot, is that you're simply trading against the dominant energy of the market. And I've been doing this for a long time. I've been trading for 50 years. My dad was a stock trader, and he got me started when I was 8 years old, and I'm 58 now. So this is literally my 50th anniversary of trading. So I can tell you, and I've trained a lot of students, and I've watched a lot of them trade, and I've traded with a lot of them. And one of the things I see over and over and over and over is them constantly trading against the dominant energy of the market. Now, what I mean by that is the momentum. So what is momentum? Momentum mathematically is literally velocity times mass, right? That's just the physics of momentum, velocity times mass. So if you think about it, momentum is kind of like a train going north. That train, if it's going 60 miles an hour, there's your velocity, and it's got 30 cars behind it, so it's very heavy. It's got mass. Now, momentum is a potentially leading indicator. And you know this. You know this. I know a lot of people say there's no such thing as a leading indicator. Well, you know differently, because you viscerally know, everybody knows just intuitively, if that train, just to use a real life example here, if that train's going 60 miles an hour with 30 cars behind it and you press the brake, that train is not going to stop on a dime. That train will continue to go into the future north for another mile before it stops. That's the leading nature of the physics of momentum. Now, let's apply that to the markets. So, going back to my experience in Chicago, what's velocity? Velocity is the speed of the orders coming in. What's mass? Mass is the volume. Now, if you really want to get professional with this, you don't have to go to the exchanges. Most of the pits are closed down now anyway. Bring up a time and sales window. Bring up a time and sales window. And you can filter it to only show you trades of a certain size, because volume is important, that mass, but let me tell you, it's the subset of mass that's more important, and that's the smart money. So, in Chicago, we could see, okay, who is trading, who's in the pit. A lot of orders are going through, but who is placing those orders? They might be coming through fast, you might have velocity, but it's all the guys who are bartenders at night, and they're trying to become full-time floor traders during the day, and most of them are failing. On the other hand, oh wait, Goldman Sachs is involved. Wait a minute, Citibank's involved. Oh, dang, Merrill's involved. Okay, that's a different story, right? Now you got the smart money, now you got the whales. So part of my whole philosophy of trading, I call it hooking your wagon to the whales. So you take your little pile of money, you put it in your little radio red wagon. Boy, I'm really aging myself. Put it in a little wagon. Young kids won't know what a radio wagon is. So you take your little pile of money, put it in a wagon, hook it to a whale, and let it go. Whew, there she goes. So that's what momentum is. We're watching for the smart money, the big orders, and on a time and sales window, you can see not just the volume of each bar, you can see the volume of each order. So if you're trading, say, the E-minis, and all the orders are coming through with 1 lots, well, okay, big deal. Nope, that's not the big money. But if you start seeing orders coming through with 10 lots, a little more interesting. 50, 100, 300. Okay, not everyone's allowed to trade 300 contracts, right? So, yeah, that's big money. That's the smart money. All right, we got to pay attention to that. So, and you can see that. And you can also see the velocity because the time and sales window scrolls, and the faster it scrolls, the more velocity you got. So anyway, I went off a little bit more on that because I think a lot of people miss out on that. You know, a lot of people don't know how to do that, and that's so important. In fact, to me, that's what trading into the future is all about, because I'm looking for that momentum. As it starts to peter out, as volume starts to die out, as the orders start to slow down, as the big guns start to leave. Usually the market will make another higher high after that, but you don't want to be there. You do not want to be there. Okay, so anyway, got carried away on that one. This is what happens on live webinars. I get excited. Still passionate about this after 50 years. My dad traded for 70, as Jason mentioned, so I got a while to catch up to my dad. So the third energy, all right, so trend that is strong. Always ask yourself, is this a strong trend or a weak trend? That's why you're getting stopped out of trend trades. It's because you're trading weak trends, but you don't know. Nobody taught you. Well, now you know. Now you will know. Now I've taught you how to determine a strong trend from a weak trend. So if it's a weak trend, we're not going to trade it. Trend is not enough. Is it strong? Cool. Then we move on to step 3. This is cycles. This is timing your entries and exits. So again, we've got to have a timing tool on our chart. I'm going to give you my timing indicator. Absolutely free. In fact, I've got nothing for sale today. I dropped the ball. I got nothing for sale on this webinar. But I'm going to give you one of my courses for free, and I'm also going to give you access to my cycle indicator for free, so that now you will have a timing tool on your chart. So we use this because we want to know, okay, we've got an uptrend and it's strong, but I want to get in at the final cycle low so I don't get stopped out. When, right? When is that going to be? And then at what price level? That's number 4. Now, price levels, this is where our Fibonacci comes in. So as you can see, Fibonacci, fantastic, but it's only 1/5, one part of a trading methodology. Cannot be used alone, as I said. Has to be used as part of an overall trading method. And then finally, these 4 I use on the shorter term chart. Let's say they are all setting up for a bullish move. Then I look to my next higher time frame. I call this the fractal energy. And I just make sure that I'm trading in the dominant direction of the longer time frame. If I'm not, I don't take the trade. This one is a filter. This has veto power. The longer time frame is the boss. So everything might look good on the short-term chart, but at the longer-term chart, if I'm trading against the dominant energy of the longer-term chart, I don't take the trade. So 1, 2, 3, 4, 5, that's my trading method. That's all I look at, other than scheduled news, of course. And these are each measuring the, well, various energies of money flow that are not correlated to each other. So that's how we determine a probability scenario. To take this and combine it into a money-making method, I'm simply asking myself at each potential entry point, how many of those 5 energies are aligned being bullish or bearish? I give each setup a score of 1 to 5. Higher the score, obviously, the higher the probability of success. And I liken this to taking each trade to court, meaning we need 5 independent witnesses to establish a preponderance of the evidence. 5 variables. Now, the operative word here is independent. So it's not going to work. It's not about indicators. In other words, you could put 5 indicators on a chart and say, oh, I'm doing what Barry does. No, you're not. Because, for example, if you put 5 trend indicators on your chart, well, you're still just measuring one energy, the energy of direction. And that's dumb. I mean, that would be like you got 5 tools to measure one energy. It'd be like putting 5 speedometers on the dashboard of your car, right? Kind of redundant. Doesn't really help. They're all going to show the same thing. So yeah, no. The reason that this methodology works and the the strategy of choosing these 5 energies is because these particular 5 energies are each non-correlated to the other 4. So we have 5 non-correlated variables, but when they all align, now we have a probability scenario. So let's look at some charts here, just show you real quickly kind of what it looks like. So, and I don't use anything complicated. I don't use any proprietary indicators. You know, I've done a lot of complicated stuff, and I've just come back to simplicity after all this time. So I just use the 50-period simple moving average as my intermediate trend indicator, and didn't have to hire a NASA scientist to create that for me. It just gives the overall direction of the market. So trend is not really just higher highs and higher lows, right? That's part of it, but more specifically, trend is the extended general direction of, well, anything. I mean, the dictionary definition of trend, Webster's dictionary, is to extend in a general direction. Therefore, the term means a long-term move, not a short-term move. And that has financial implications because when we get in early in a new trend, and trend is a long-term move, that gives us a good reward, a good risk-reward ratio. So a little lower high, a little lower low here, that's not a downtrend, right? That's just a little complex retrace in an overall uptrend. Now let's go to the energy of momentum, see what that looks like. As we said, momentum is a potential leading indicator. So here, market moves up, higher high, higher low, higher high, higher low, higher high. Cool. Now let's look at our momentum indicator. Boom, here's the 0 line, by the way. 0 means, well, no momentum. So when it just hovers around the 0 line, market's not really going anywhere. There's no strength to the upside, strength to the downside. Usually you just get consolidation. So, boom, this thing takes off. Huge momentum, huge strength. So, I mean, this actually is easier than trading on the floor because it just maps it on the chart for you. You just trade the pattern. So why or how could we determine that this low would be a strong trend? Well, it's above the 50 MA, 50 MA is angling up, and momentum is just way up at that low. So therefore, we are in a strong trend. Higher high on price, equal high on momentum. Okay, that's a little bit of a warning sign, a little shout over the bow, so to say. Still not necessarily enough to short. This, you know, some people might trade a divergence going short there. That would be a mistake. That would be a big mistake. Since momentum leads price often, you'd be in too early. So then price does make a higher high. Now here's what I look at. The lows. A lot of people look for these divergences on highs, and that's okay, but let me take it a next step for you. Look at the lows. On the lows, we've got a higher low, but on momentum, we've got lower lows and a much lower low, right? I mean, that is dramatic. And also a lower high. When you get both, okay, that's what we call a momentum shift. And if you were in the, if you were at the exchange, what would happen is the volume, the audible volume in the room would be calming down. Goldman's leaving the pit. Merrill's leaving the pit. Or else they might stay there just to, you know, because they don't really want people tracking them at all. They do everything to avoid that, actually. But yeah, they're not placing their big orders anymore. So you got the bartenders, they're placing their orders. And so yeah, the market does make a little higher high. And then they're screwed. So momentum shift is a great indication that, oh, we are at the end of this move. All righty. Let's see here. I got a little behind time, so I'm just going to skip that slide. That basically says the same thing. I want to catch up here, make sure we're done on time. Cycles is energy number 3. This is the timing of the market. So I consider this like the rhythm of the market. Inhale, exhale. Inhale, exhale. That's what markets do. So you can also think of it like weightlifting. When you push a weight up, you exhale, right? Whew. When you pull it back down to get ready for the next push, you inhale. And then whew, push it back out again. So that's what the market's doing. It exhales, whoosh. And then it inhales, gets ready for its next move, exhales. Inhale, exhale. So this indicator, which I will give you for free and teach you how to trade it, because it's not really intuitive how to trade it. This is actually just part of the indicator here. But anyway, this shows you the cycle highs and lows. All right, the timing, time. But again, so you got a cycle low here. We wouldn't want to buy that. Why? Because we're in a downtrend. And so cycles tell you timing, but they don't tell you momentum, and they don't tell you direction. So you've got to be selective about which cycles you want to trade. Let me put that all together for you. Energy number 4, support resistance. Again, just to reiterate our Fibonacci. So we have this impulse move there. It went right through 23.6. Why did it slice through 23.6? Because it wasn't time to put in a high. See right there? Our timing indicator is still screaming up. And so we've got to look for the confluence of time and price. So let's just look at this one here to make up some time. So now we've got a cluster of support resistance. Cluster is this high, the swing high, and the 50% retrace. So we've talked about why clusters work. We've got a nice topping candlestick pattern. Look, cycle indicator. Time to put in a high. Confluence of time and price. That's why that holds. And then, is there much strength going up? No. There was a lot of strength going down here. There's some strength going down here and we made a lower low on price, higher low on momentum. And remember what I taught you. Look at the highs and the lows. So here we have a lower low. So well, let's go all the way back here. Lower low, lower high on momentum. Lower low, wait a minute, higher high. There is your previous high. Higher high and higher low. Look at them both. That's your momentum shift. We're done, at least for now. We're done for now. Market's going to regroup. Comes back up, ABC complex retrace, but it comes up on weakness. Therefore, again, resistance holds through weakness. You can't have a lot of momentum going up and expect resistance to hold. And then it goes back down. All right, finally, the fractal energy. So looking at multiple time frames, on the short-term time frame here, trend is down. We retrace to the 15 EMA. Cycle indicator, great. That's like an amazing cycle indicator signal there. Momentum holds below 0. There's your 0 line. So we've retained bearish strength. And then over in the longer term time frame, momentum is also down. And that's what we want. I want momentum down on both time frames. I want strength in both markets or in both time frames down. So this method, I've started as a stock trader because that's what my dad did, but then I branched out into commodities, options, currencies, futures. I trade all these markets now, and I use the same 5 energy method for all the markets. I do investing. I actually manage a pension plan. I do swing trading. I do day trading, and I use the same 5 energy method because it's just mathematical, right? An indicator, what's an indicator? It's a math formula. That's literally all it is. So it's going to take data from whatever market you're trading, whatever market you put on that chart, relative to whatever time interval you set that chart. That's the data it takes and plugs into the left side of the indicator, crunches it based on its formula, and then spits out a value at the right side. So the indicator's already adapting for whatever time frame and market you put on there. So that's why it works for any time frame or market. It's simple. We're counting to 5. We got to keep things as simple as possible because one of the things that kills traders is information overload or emotional overwhelm. I don't want to be overwhelmed with information. So you've got to keep things simple to be an effective trader. So here are my freebies. I told you I dropped the ball and didn't have anything to sell you today, so I apologize profusely for that. I know I'm breaking your hearts. But I will give you one of my free courses, and this course is called Make Money by Breaking Every Rule You Ever Learned. And basically it talks about how technical analysis has changed. You can't use all the stuff from classic technical analysis anymore. The reason for that is that the Bible of Technical Analysis was written in the 1940s. Well, heck, that's even before I was born. So, you know, when I was raised, I'm old, but I'm not that old. But even when I started trading, we had black and white TV. So, and the 40s were before that. So anyway, you didn't have computerized trading. The commoditization of retail trading wasn't around. Direct access wasn't available. we didn't have computers, no algo trading, no high frequency trading. Commissions were super high, cost me $50 to get in, $50 to get out. And spreads were wide because we had fractions then, not pennies. Anyway, bottom line is all that stuff added up to this. Markets moved differently. They tended to trend more, and today markets are more choppy and chaotic. So you've got to trade what works in today's markets, and that's what this course is about. So 5 20-minute video tutorials, interactive quiz at the end of each one. I'm actually not going to just give you theory. I'm going to give you one of my free trade strategies called the rubber band trade. So you'll actually be able to hopefully take that and make some money with it, but please trade it on a simulator or a demo account first. Understand most people don't make money trading, and past results are not indicative of future performance. So always, always, always be very, very risk averse and careful. Test everything more than you think you need to before you trade with real money, if you ever decide to trade with real money. But this is a trade that I personally still trade to this day, so it's a real good trade. And then my cycle indicator that I've mentioned, yes, happy to give that to you for free. It's actually a modification of an indicator that's already on every trading platform out there. So I show you how to make the modification, super easy, and then how to trade it. And it's not really intuitive how to trade, so I teach that on another webinar, which is also free. It's also an hour-long webinar. And we set it up on your charts. That's super simple. That takes like 5 minutes. And then I show you patterns to trade on the indicator for your entry and exit signals. And it's those patterns that takes about 30 minutes to teach. So free webinar, and you can get all of this stuff at one place. And there is the link right there. In fact, let's go ahead and let's just type that into the chat box. And actually, I can't do that. So maybe, Jason, if you can type that into the chat box and the question box, this link here, that would be great. Yeah.
Of course. I'm happy to do it. I'll do it right now.
Alrighty.
And before we all race in different directions, we've got a few questions here for you if you got a minute, Barry.
Absolutely, I'm happy to. Yeah, I can't see the questions, so if you can read me a couple of questions, I'll be happy to do my best.
Of course. Okay, so the first question that's coming through, and for the audience, I'm putting this link here in. Just bear with me. There it is. So there's Barry's link. All right, so Barry, I'm going to go through these rapid fire. I know everyone's racing. It's Wednesday. The first one from Lauren. How do you fix scale in MetaTrader 4? Is that something we can answer real quick?
I can answer that really fast. I don't know.
Okay.
I don't use MetaTrader 4, so yeah, contact them. That's a software-specific question. I'm sure their support team can help you with that. I don't use the software, so I don't know.
Anastasia is asking, so what momentum indicator do you use? And if you've already covered that, we're probably good, but...
Yes, that's something, there's many momentum indicators out there for you to choose from. The one that I use, I only offer in my paid courses because, again, it's not just about the indicator. There are certain patterns on the indicator that I trade. And so it's just giving you the indicator would be of zero use. Also, I don't use the default version of the indicator. So it would take a long time to explain that, and that's not something that I ever give away for free.
Okay, understood. Two questions regarding time frame. One from Penelope would be one question regarding time frame. What are you using this to make swing trades or day trades? Since you're using short time frame, assuming that you're dealing with day trades.
Either one. I do the same thing with day trading, swing trading, and investing. It's just a matter of what time frame you want to use. I'm just using, I do certain examples here, so don't think these examples of the time frames I used are the only ones that I trade. They're not. I use them on monthly charts for my investing. I use them on daily charts for my swing trading, and then I use various time frames for my day trading, depending on the volume of the market.
Got it. Okay. One other question from Armand, and Armand, hopefully I'm saying your name correctly. What do you mean by 3x or 3 times the chart pertaining to fractals?
Okay, good question. So it's a ratio of 1 to 3. For example, if I was trading a 5-minute chart, then I would look at a 15-minute chart because 5 times 3 is 15. So that's my ideal ratio. You can do this with tick charts also, by the way. So if you're trading a 1,000 tick chart, I would look at a 3,000 tick chart. And you can do it with pretty much anything. You can also do a 1 to 4 ratio, and that's pretty good. I find that if you get beyond a 1 to 4 ratio, like 1 to 5, 1 to 6, then the problem is the longer term chart is lagging so far behind. The timing of the two charts are not synchronized tightly enough to give you an accurate confirmation on the long term chart with regard to the specific timing of when you're going to take that trade on the short term chart.
Great. Okay. We have another question regarding timing from Carlton. And Carlton, I'm assuming that Barry's response applies to this one as well. But what time frames work best for Fibonacci? So both time frames, right?
Yeah, I'll use Fibonacci on both time frames. There's no time frame that works the best. But I will tell you this, I do get a lot of questions about time intervals. In fact, it's one of the questions I get most frequently emailed to me. And so what I did do, and it's an important question, by the way, so a good question, because it is important. So what I'll invite you to do, and this is for everybody, that you can send me an email at barry@topdogtrading.com, and I will be happy to send you a couple of articles that are on my blog, so they're free. I'm going to just type this in here, and maybe there we go. Jason can copy and paste that.
Of course.
But yeah, just send me an email, barry@topdogtrading.com, and request the articles on how to choose the best time intervals for your charts. And we will send you the links to the blog post, and there's even a video or two on there. And it goes through all the details. I'll give you a quick little preview, though. A lot of people think that there is a best time for making money. That's not really the truth. There's 3 factors I'll go through real quick just to list them. So one is the volume of the market. I'll use a different time frame based on how much average daily volume that market has. Number 2, the size of your trading account, because you've got to exercise proper money management. So for example, myself, I won't risk more than 2% of my trading account on any one trade. Therefore, when I look at the time interval I'm trading, I've got to look at the average range of the swing highs and swing lows to determine what would be my average risk on a trade on this particular time interval. If that's going to be more than 2% of my trading account, I've got to go to a faster or shorter time frame where the range of the bars are more narrow, and I can fit that into my budget. The third one is psychological, and that is just how much time do your brain cells need to comfortably analyze the chart and make a confident decision and execute the trade. So that varies from person to person, and that's a gift that only you can give yourself through experimentation.
Cool. Do you have time for 2 more quick questions before we go?
Jason, for you, I have a lifetime.
Oh boy, oh boy. Okay, so very quickly, there's looks like there was a couple of books that was written. In a study on Fibonacci, a German math professor came to the conclusion that Fibos are human-made. Also, Brent Penfold in his book was very skeptical. Not sure if you've heard of either of these. Klaus wants to know what you think of that.
All right, Klaus. Excellent question. I love it. Good Fragen. I don't know if you're German or not, but so yes, I actually happen to agree with that. So my philosophy on it real quick, this gets into the theoretical stuff, which I do talk about in another webinar, but since it's asked, we'll address it real briefly. I do agree with that 100%. So what my theory of how Fibonacci became popular in trading is that, obviously in nature, in the structure of nature, architecture, all this kind of stuff, these Fibonacci ratios are very significant, and we do find them. So there it's valid. And then somebody said, gosh, it's valid in nature and mathematics. I wonder if it'll work in trading. So they applied it to trading, and they found that, yeah, markets do kind of bounce off these levels. I don't think it's really because the market works on Fibonacci ratios. I think the reason that they found it kind of worked was because the human mind works in thirds and quarters. So we kind of go toward, okay, I'm up half, or I'm up a quarter, or oh, I'm down a third, things like that. And these ratios, if you think about it, 23.6, 38, 50, all this, it comes close enough when you draw the line on the chart. And the price bar never gets to exactly the penny, pip, or tick of that line. It always gets in that zone. But those ratios are close enough to a quarter, a third, a half, two-thirds, and three-quarters. And the human brain works that way, and so then that's just how people are thinking of their money. And so then they're like, ooh, wow, Fibonacci works. Ooh, the magic number, the golden mean, and all that kind of stuff. And I don't think that is really why that happened at all. I think it's just that our brains work that way. But now, okay, now moving forward, because it's been so accepted, now a lot of people use these actual ratios. Now Gann, he used to actually use quarters, thirds, and halves. And so you could do that if you want to, but now Fibonacci kind of has a self-fulfilling prophecy because so many people use it. But I would agree that originally it was just kind of a coincidence that those ratios were close to the math psychology of the fractions that people use to measure their wins, their losses, and where their greed and fear come into play.
Cool. Okay, one last question here, and folks, if you have more questions, we'll encourage you to email Barry directly. Is the RSI indicator good to use with Fibonacci? And that's from Yimi, and hopefully, Yimi, I'm saying your name correctly.
Well, hi, Yimi. Thanks for your question. Yeah, I mean, RSI can be fine. When I get asked a question, is this indicator good or is that indicator good? There's so many ways to make money trading. I don't personally use the RSI, but I've got a lot of friends who do and who do very well and make money. And yes, it can definitely be used with Fibonacci. So it's not particularly better than any other indicator, but it's an indicator that can be used with Fibonacci if you learn how to trade it. So there's no magic indicator out there. Let's, again, just to be real literal, I'm a very literal kind of guy, as you can probably tell. So indicators are not magical. They're mathematical. They're literally just math equations. And what does an indicator do? Well, the answer is in the question. It indicates. It doesn't tell. And it certainly doesn't make you any money. If they made us money, we'd call them what? Money makers, right? So do not get enamored with indicators. They are, they're mathematical formulas. You got to understand what it does. So what does RSI do? I'll just throw this in just to just a little more provocation. So there's a lot of indicators out there, such as RSI, that are called momentum indicators that are not momentum indicators. What? Oh, there goes Speary again, another heresy. Well, here's why I say that. In traditional technical analysis, yep, it fits into the category of momentum, but it's not. It is an acceleration or velocity, or probably the best term would be rate of change indicator. And the reason that it's not, and most of these rate of change, stochastics, MACD, what else? CCI, all these things categorized as momentum indicators are not, is because they do not incorporate mass. And as we talked about in physics, momentum is defined as velocity times mass. So these indicators, they do measure velocity, but they don't measure mass or volume. So to have a true momentum indicator, you have to have one that incorporates volume. Otherwise, you're just measuring rate of change, which, again, is not bad, but just understand that. Be aware of your indicators, what they do, how the math works, what's it really telling you. And you've got to be aware of that. So ancient Chinese saying I just made up. The dollars are in the details.
I love it. One other question. Do you use wicks when drawing fibs? And that's...
Yes, good question. I forgot to address that. That was in the bullet points. And yes, I do recommend that if you're drawing, for example, your Fibonacci retracements, yeah, you do it from the high to the low. You use the wicks, yes.
And one last one that looks like it slipped through has come through. Sorry, nothing slipped through. Have you used volume profile?
Yes, I have. Volume
Okay.
profile. Yep, it's cool. For me, it is just it's good. So on my charts, I always put in the value area high and value area low. I find those very, very valuable. That's all I personally use of market profile because, well, they don't actually use bar charts, obviously, but it's all based on 30 minutes, and it can be good, but for me, it's just not as precise as I like. So my cycle indicator is very, very precise. I love precision in my trading. So I think market profile is good. It provides some nice levels to be watching, and I do plot, like I say, those value highs and lows on my charts. But that's all that I use it for personally.
Cool. Cool. Okay, those are the questions. We found our way through all of them. Everyone, thank you very much. And Barry, thank you. That was awesome. I really enjoyed that.
Well, thank you, Jason, and thank you for your hospitality. I really enjoyed being here, and I hope people got value out of it and will continue to get value out of the other things that I share. So I've gotten a lot of free stuff. Feel free to go to my YouTube channel, Top Dog Trading. Just type it in. I've got over 100 free videos there. Get the free course here. I've got a podcast called Online Trading to Win. Online Trading to Win. All free. My blog, topdogtrading.com, is just a blog, so everything there is free. I give away a lot of free stuff. I'm not a very good salesman.
Uh, we have Armand. We have one last question on thoughts on range and tick charts. Do you use those, or do you have a preference for those, one or the other?
Again, it's a good question, and they can both be used very effectively. It's just a matter of understanding what they are, which I'm sure you do. But forever, anyone who wants to use whether time-based bars, range bars, tick bars, volume bars, all the different kind of bars that are out there, just understand there are pluses and minuses to both. So range bars can be good in helping you stay out of choppy markets, so that's one of the benefits. One of the downsides of them is that they don't tend to show extremes very well, and I like to see extreme action, irrational exuberance, if you will, as Alan Greenspan would call it. That stuff's very, very important. We love to see, or I love to see, when the market gets beyond the, the sweet spot of the bell curve. So when the market overreacts, that's really a great trading opportunity. And so range bars are fine if you just want to, be a nice trend trader, and it has its strengths, it has its weaknesses. Just be aware of both. In fact, I have an article on. I don't talk about range bars there, but I do talk about the advantages and disadvantages of time-based bars versus tick bars. And if you want that, again, it's on my blog. Just send us an email and we'll direct you to the right article. It's a couple of years old, so I don't know the URL right offhand. But if, for example, just one quick one here, if you love candlestick bars, if you love to trade candlestick patterns, then range bars are not for you. And tick charts are not going to be as good either. Then you're going to want to go with time-based bars. Time-based bars give you the best candlestick patterns. So it's just a matter of, is that something that's important to you or not? So there'd be one example.
Very cool. Very cool. Barry, the kudos are coming in. Lots of great feedback on this webinar. Lots of very appreciative comments on the content that you provided, the detail that you've gone into. So this was a very brilliant webinar, is a direct quote.
Oh my gosh.
And, yeah, and they're still coming here. So
wow.
Thank you so much. For those of you that are asking about the recording, of course, this is being recorded and we will post it. You will also get a follow-up email with a link to the recording, as well as to the links to the that Barry's provided here. And by all means, if there's anything else that you need, please don't hesitate to reach out to Barry directly. Okay? All right. I think that's probably a good place to call it good on a Wednesday evening.
All right, Jason, thank you very much, and thank you to everybody who attended. I really appreciate your kind words. Thank you so much, and happy trades.
Happy trades. Thank you, Barry. Okay. Good night, everyone.